Hello, my name is Trey Henniger, and I'm the host of the DIYInvesting YouTube channel. Today we will be discussing the magic formula investing strategy, all explained in 4 minutes or less. Here we go. So the source of the magic formula is Joel Greenblatt. He wrote about the formula in his book, The Little Book That Beats the Market, originally published in 2005. The magic formula has two ingredients. The first ingredient is earnings yield, and earnings yield is basically your profits of the company divided by price. And so your basic premise is that the cheap companies are going to be better than more expensive companies. So to demonstrate this, the return you can expect on investment is going to go up as your earnings yield increases. So the lower your purchase price, the higher the profits per share that you're buying. Your second ingredient is return on capital. So basically this is profits divided by the amount of capital invested in the business. And this is a way of measuring whether a business is good or bad. So your premise then is that good businesses would be better to buy than bad businesses. So again, if we look at what your expected return on investment would be compared to return on capital, it should go up the higher the return on capital. So then the lower the capital that's needed to produce your profits, the better. So how did we combine these? We put them together. So you take the earnings yield, and so I've charted out 4 quadrants. You have the earnings yield from 0 up, and you have a return on capital from 0 increasing. And so your bad quadrants down here where you have a low earnings yield and a low return on capital. But your good quadrants up in the top right-hand corner when you combine them, your high earnings yield and high return on capital. The magic formula is trying to capture this relationship and only choose companies in this top quadrant. So your goal is to buy profits. The lower the price, the better, and the better the business, the better. So let's look at the magic formula in action. Your first step is you would take a list of every single company within your database, and you would rank them from, say, 1 to 5,000. So first you do the earnings yield, and the best company in the list with the highest earnings yield would get the rank of 1, and then the worst company would get a rank of 5,000. And you would do the same thing with return on capital. Each company would then receive points according to their ranking, and then you would add them up. So the lower is better. If you're ranked first in earnings yield but 100 in return on capital, you'd receive 101 points. Your goal then would be to buy and invest in the 30 companies with the lowest point total. After 1 year, you would sell and then repeat the process. So what are the results? According to Joel Greenblatt in his book, the magic formula beat the S&P 500 index by 18% each year over the 17-year backtest period. This means that the total returns for this magic formula method exceeded 30% annually. This is compared to the S&P 500, which earned only 12%. So why would that work? It seems a bit skeptical that a single magic formula could beat the market like this when it's just picked companies by a computer. Well, the reason it works is because it can often underperform over shorter time periods. Anything from 1 to 3 years, you could be doing this and yet continue to underperform the market. And this short-term failure is what causes investors to quit before it becomes successful. And because investors quit, it keeps working. Because the magic formula works best over longer time periods, like 5 years. So, do you have what it takes? So first you should read the book, and this is available with my full book review at DIYInvesting.org/littlebook. And then the next thing would be is to actually go and purchase your magic formula stocks. If you watch the next video in this playlist, you can find out how I recommend you do so. I'll give you a hint. I built a magic formula index to make the whole process super easy for you. So thank you for watching. Please subscribe below and visit our website at DIYInvesting.org for more education, tools, and resources to help make you a better investor. Thank you.